Take a look at this chart. You've executed a perfect buy order right here at a price of 100, and like a responsible trader, you place your stop loss down at 90 to protect your capital. But then the market starts to turn. The price plunges to 85, striking your red boundary and automatically locking in a loss. And then the absolute worst thing happens. The moment you're taken out of the trade, the price violently reverses. It rockets right past your original profit target. Your initial prediction was entirely correct, but you're still walking away with less money. This experience is called a whipsaw, and the frustration it causes pushes many newer traders to make a fatal error. They stop using capital protection altogether. They feel cheated by the market and decide the tool itself is the problem. The reality is tied to basic probability. There is no trading strategy in existence with a 100% win rate. Taking losses on a portion of your trades is a mathematical certainty. Removing your safety net doesn't stop market manipulation. It only ensures that when that inevitable bad trade finally happens, it will wipe out the profits of 20 successful ones. To survive, you have to stop placing these limits based on random, emotional numbers. Your defenses need to be geometrically anchored to validated market structures. This chart shows a standard downward trend. When the market is forming a descending staircase like this, your defensive boundary belongs horizontally just above the upper wick of a prominent bearish or red candlestick. When the structure shifts upward, the rule flips. You place the line directly below the bottom wick of a bullish green candlestick. Trending markets are just one environment. You also have to navigate sideways markets, where the price bounces horizontally between support and resistance until it finally breaks out. Here is a chart showing that exact sideways movement. When the price finally pierces the top barrier, your defensive line goes slightly beneath the lowest point of the specific candlestick that broke through the channel. If you wait for the price to temporarily fall back and retest that broken barrier before you enter the trade, your statistical probability of success goes up. By tying your stops to these specific structural extremes, you remove the guesswork. You turn a random line on a screen into a mathematically sound defense. Knowing where to build those defenses is only half the battle. You also need to know the 3 specific environments where even the best technical placement will fail. The first is during major macroeconomic news drops or inflation announcements. These events create extreme volatility. The market churns violently, completely ignoring technical chart analysis. The second danger zone involves psychological round numbers. Look at how the price action interacts with this 1000 level. Setting your limits at clean, whole intervals like 500 or 1000 acts like a magnet for institutional trading algorithms. The third trap is placing your safety limits directly on top of an obvious support floor, right where thousands of other retail traders are placing theirs. Institutional algorithms intentionally push prices just below these obvious floors to trigger all those retail limits. This is called a liquidity grab. They take your money to fuel their own trades, then immediately reverse the trend. If you recognize and avoid these highly manipulated zones, you stop handing your capital over to institutional market makers. Your safety net does not have to be a static, immobile floor. You can elevate it into an active, dynamic tool. This chart displays a W-shaped double bottom pattern. You execute your entry right here at 1000, and you establish your defensive floor below it at 990. The market reacts favorably. The offset climbs upward, reaching a new peak at 1050. Instead of leaving your defense down at 990, you manually trail the floor upward, locking it exactly at your 1000 entry point. If the market suddenly collapses and hits this new floor, you exit with 0 profit but 0 financial loss. Mastering this dynamic trailing defense removes the fear of a sudden crash. It is the final step in moving away from reactive, emotional choices and executing trades like a professional.